We start off with the rally heard round the world, literally. Emerging markets hitting the highest level since August today, adding to the global rally we've seen this year. China, the U.S., Germany, Brazil, Japan, all up double digits as hopes of a trade deal loom. Does this rally have legs? What should you be buying? Is there an emerging market specialist in the house?
Oh, my goodness. Man, I'm in a different seat tonight, and therefore I get this assignment. I think, look, if you think about the data that we had last night in China, it's reason to be excited. It's not reason to do cartwheels. You had services data, which is the best in 14 months. But the bottom line is that the PBOC in the short run is actually throwing deleveraging out the window, and they're throwing as much credit at the problem as possible. What it means also for the rest of the regional markets and certainly the regional economy is very good. But obviously, as we're also getting closer to yet again another trade deal, it seems like we get a little boost from this every single time. The technical guys will look at the EM, semis, pick something global cyclical, and we've actually extended the move. So we've gotten through resistance. We're at fresh levels now for a lot of things that we're running into the same areas. And look at the DAX. I mean, if anything, Europe's probably been the most beleaguered market across the board. DAX traded strongest really anywhere in the world today on the back of really not great data over there and PMIs that aren't showing you anything great. But yes, I think global data for the short run has bottomed. I've been saying this, and I think this is what we're seeing.
I mean, the key seems to be if you believe there is a turn in China, that means all sorts of good things for the other markets in that region as well as in Europe, particularly Germany.
Yeah, so just to play devil's advocate, because why not? So let's play. There's clearly a turn in China. They're clearly throwing money at it, but does that embolden them not to do a trade deal? One of the things people said was, the China market's down 30% at one point at its trough. They're going to be forced to the table. Those markets have come screaming back. Now, are the Chinese in a better position now not to do a trade deal with the United States? I don't know what that means for the markets. Clearly, it doesn't mean anything, but I would say it's emboldened them to sort of string this thing out a little bit longer, quite frankly.
Can I take the other side of that?
Sure.
Yes. Okay, I mean, you could look at it. We were down a lot, too, at that same time, right? So you could, if you wanted to make that argument, and I don't really agree with it, is that we would have a stronger hand. We would have a stronger hand, and you could say they would have a stronger hand. I think we are both better off because we perceive there to be some progress, some real progress, and we do seem to be getting to what I hope are more granular issues so that we're really closer to the end, which I think would be better for all of us.
And I don't know necessarily if the rally back, either in China or in the United States, is entirely on hopes of a trade deal. I mean, at that same time, we are also getting a Fed that pivoted in a major way, and then we also got China throwing a whole lot more stimulus on the economy. And so even without a trade deal, or let's say the trade deal gets strung out, whatever it is, we've got stimulus here.
We've got stimulus here. We've got a Fed that seems to be much more cooperative for the markets, at least right now, and we'll see how things play out the rest of the year. But I think the reality is, strong hand, I'm not really sure that's the right way to say it. I think, to Karen's point, I think the reason that we're seeing China start to move to the upside is the hopes of a trade deal. And I think that's what's really pushing it. And when you look at names like JD, or if you want to go to ASHR, it's the China 300 A shares. You look at these things, they're from 21 to 31 this year alone. I mean, these are running and screaming to the upside. We see derivatives activity like I've never seen. Those are names we used to see once in a while. JD, for instance. ASHR, never saw it before. Never saw it before.
So
this year, it's hit 14 different times since the start of this year with unusual option activity, looking for more upside. We even had some more today in both names. So I think that this is signaling not necessarily the strength necessarily of China. I think it's signaling more, hey, look, there might actually be a deal here that'll be good for both sides, actually.
Well, I also just think that I think this deal is actually, so you may think that actually this may embolden the Chinese. I think the Chinese love the deal that's on the table right now. I don't think China's really given up anything. I think this is actually a deal that, if anything, means that it gives them the ability to buy stuff they were already going to buy. They've actually paid some lip service to some technology transfer. But in the scheme of really where they're going for China 25 and one belt, one road, I don't think China's given up anything at all. I think they'd be very happy to call this a deal right here now, whatever those details are.
Okay, so let's say there's that turn in China and you see the options activity, Pete. Do you go one step further in the trade in that you also are bullish on Europe in other parts of the world that are so dependent on China and a turn in China, whether it be because of the trade deal or because of
I think it would be reason to have some bullishness about that, but I think there is much more going on within those economies and less about China. I think all of Europe right now has all kinds of different issues, and it's not just China related. I think it's within themselves. And so for that reason, I'd rather either be in the U.S. I love being in the China names. I'm in those two names that I mentioned. But I look across Europe right now. I still see too many holes, too many debts, too many issues across so many of those countries that I'd rather just stay away.
It's interesting. You heard the sirens. I mean, that's somewhat frightening.
It was like well timed, right?
Yeah.
It was cue the sirens.
So we'll talk about chips later. People at home are probably wondering why we're not talking about. We're going to talk about the chips later because that's its own animal,
chips.
right?
Huge.
I mean,
Yeah.
without question. But what you have to bring up, I think, is the fact. Listen, I think Deutsche Bank is paying attention to what's going on with these trade deals, right? One has to. I mean, they're not living in some vacuum. Yet today they downgrade Caterpillar, which I think we would all agree to some level is sort of the poster child for global growth and a potential for a deal with China. They lowered their price target from 152 to 128 in the midst of all this. So they're clearly seeing something. So I would agree that there's no question the hopes of a trade deal have sort of buoyed this market. But you can't deny the fact that the Chinese have thrown liquidity in
So this is a head fake. The recent turn in China.
I'm just saying.
And the rise in the markets.
I'm
head fake.
just saying.
I don't think it has to be even necessarily a sustainable long-term economic move higher. Be clear also, the delta on the Chinese economy has been 1/3 of global growth for the last decade. So it's important that we see something here, and I think we're getting that. But back to what's working. The cyclical trade has not just been semis. It's not just been emerging markets. It's been materials. It's been energy. It's been anything that actually has been almost seemingly not happening with reflation because when we look at yields, but actually you are getting reflation. And I look at copper prices, energy prices. Energy has been the best trade this year. Yeah. I mean, if you look at crude, it's been the best chart in terms of volatility, in terms of consistency. And I think these are trades that you stay with.
And to Tim's point, energy has absolutely been the biggest of all the different derivatives categories right now so far in the first quarter. It was energy, in my opinion. And if you look at a lot of the different disclosures I have right now, it's energy. And last time, I think about a week or so ago, I think I have 13 different positions in different energy sources. And it's all because of the unusual activity. And obviously, this move in oil, I mean, we're watching it right in front of our eyes. Just that steady move up towards 60, pushing on 60, pulling back, getting over 60. I think energy definitely still is the play. And I think this quarter, I think energy is going to have another good quarter.
So just emerging markets would make me at Brazil with energy. As ugly as Brazil is, I think you got to have some exposure there as well.
Let me connect the dots back.
When I was a kid, actually, they didn't let me into nursery school.
Why is that not surprising?
You couldn't connect the dots?
I had trouble connecting the dots. True story. It's like 1967.
You couldn't count because dots are. It's
I don't know what Tim. I told you before the
Anyway.
show to turn off your phone. Yes, I'm sorry.
Nobody heard that other than you, and now everybody else.
If you think that the turn in China is a head fake, then can you believe in that global cyclical trade, energy, materials, et cetera?
Yeah, I think so. I mean, I think the
Can.
energy. Well,
It
the
doesn't-
energy
it's
because
not
energy is going higher for different reasons. I don't think energy is going higher because you have some global reflation, acceleration of economic strength. I think it's all function of the fact that you have central banks around the world torching their currencies and commodities are going higher. So you can believe they're going to go higher. I just believe they're going higher for a different reason.